Welcome back to Overtime. The S&P 500 touching its lowest level in more than a month to kick off September. And Schwab says the pain is not over yet. Joining us now, Omar Aguilar. He is the CEO and Chief Investment Officer of Schwab Asset Management. It's good to see you again. Welcome back. It feels like everybody now is on the same side of the boat. More downside, more volatility. But you heard the professor, I hope. He's not as negative as everybody else because he doesn't think the Fed's going to do nearly what it says.
Well, yeah, thank you, Scott. Thanks for having me, and it's good to see everyone. Well, you know, the volatility is probably the biggest driver of what we're going to see for the next few months. I think the market continues to try to gauge, you know, this trade-off between inflation and economic growth. And, you know, when it comes down to, you know, what is going to be faster, whether inflation is going to come down faster or the economy is going to just go down into recession, that particular trade-off, everybody's thinking for the Fed, then will make the call. The reality is that a lot of the data points that the investors are focusing on now, they tend to be lagging indicators. And I think what we're going to hear for tomorrow in terms of labor market, you know, still, you know, it's a lagging indicator of what may happen with the economy. And the reality is that, you know, the Fed will continue the quantitative tightening. We have been on the book of basically saying that the Fed will do anything they can to try to get that inflation and that demand destruction to try to keep in that stability they're looking to do. That obviously has ramifications, and the first one is higher volatility. We should expect higher volatility as people are starting to transition to that last phase of the economic cycle.
So you believe the Fed? You take Powell, the chairman, to be respectful, Chairman Powell, at face value, and all of the other Fed speakers who have come out and certainly sounded hawkish over the last many days. You believe that they're going to follow through on what they say?
We believe that they will do whatever they take until they see that the inflation numbers stay in a course that they can control. I think the possibility, and if you think about the odds of a 75 basis points hike in September, is roughly around 70%. And what that tells you is that, you know, the market is clearly believing that the Fed has less downside in trying to be aggressive and hawkish right now than it is trying to just, you know, give the market what they want, especially when you have still a fairly strong labor market, a fairly strong consumer, and then granted that that's a big part that is reducing. I think the stage of the consumer is probably an area that we'll be looking into the next, you know, month or so to figure out how that evolves, because until now, that has been a very strong part of our economy.
I feel like you're painting a no-win scenario for stocks, at least in the near term. I could be wrong, but it certainly sounds like that's sort of the point you're making. But even given that, is there opportunity to be had in the stock market? And if so, where is it?
Well, you know, I would probably just to be clear, we always encourage people to think about the long run. And I think this part of the volatility, it allows people to rebalance their strategy. So, you know, equities, you know, always have a space in the portfolio. And while they may be painful during short periods of time, it is very clear that in the long run, and I think, you know, the professor was saying this earlier, you know, they provide protection for inflation, they provide price appreciation, and they also provide income. So, you know, we always encourage clients to try to look at the whole picture and the long term as being part of their investment strategy. Now, yes, over the course of short periods of time, there will be volatility, and clearly risky assets tend to be more volatile than the non-risky assets. The same thing happens when you see a yields of, you know, attractive as we have now in government bonds. You know, obviously there is a space for that you can actually put when you put them together. So stay the course on your long-term strategy. Try to look for those opportunities, and yes, be prepared to be sealing this volatility, and that's what long-term plans help you with.
What about outside the U.S.? We don't talk about it as much. Maybe we should. Should we?
Absolutely. And if you actually think about, you know, what the dynamics are right now, you basically have a situation where the dollar is being very strong in combination or a China slowdown and a significant, you know, chances of a big recessionary components out of Europe. When you actually put all these pieces together, number one, you know, allows you to seek opportunities of rebalance again with an international component, particularly on the developed markets. But at the same time, that strong dollar is actually pretty good in terms of reducing the effect effects of inflation when you actually think, what may come, down the pike. So overall, looking at international is always healthy for looking for diversification opportunities, but at the same time for looking of, how you position your portfolio for the next phase of the cycle.
Gotcha. Appreciate the time. As always, Omar, thank you. Be well. We'll see you soon.